Okay, we've had our introduction on the foreign exchange market and how the economists will model it with the supply and demand graph. But before we go further with it, we want to talk about why does anybody want foreign exchange at all? And it basically comes down to three reasons that there would be a need to exchange your currency for another one. And the first one's probably the most obvious. It's if you want to buy foreign goods or services. We buy foreign goods all the time in the store, and of course we do pay dollars for it, but that's at the retail level. Anytime you've had goods imported into your country, somewhere in the chain of events, a dollar got exchanged to that country's currency so that those producers can be paid in their currency. So all sorts of imports and exporting is just representative that there has been some sort of foreign exchange transaction. So buying stuff is certainly a key reason. A second one, if it's not actually buying stuff, then as in goods and services, then it's maybe buying a investment in the other country. You could be buying stocks and bonds that are in the foreign country. You could be buying property. All sorts of things would require you to convert your currency into their currency in order to make the transaction. And then the third one we won't spend too much time on, but it is an important part of the foreign exchange market, and that is speculation. Speculation would be done by the big money managers who are buying and selling currencies all the time in large amounts, and they are operating on whatever information they have to make them think that a currency is going to be getting stronger or weaker. So generally you want to buy a currency when you think it will be getting stronger, so you're kind of buying it low and you'll wait until it goes up and then you'll sell it high. So these are really the only three reasons that anyone would buy foreign exchange. And what we're going to see then is once we understand these three reasons, it will help us understand how the supply and the demand for foreign exchange will change. All right, so here is a prettier picture of the supply and demand of pounds for dollars. And what we want to look at here, let's just take a moment to review what we're looking at. We've got our demand for pounds coming from Americans, demands for pounds in exchange for dollars. And we have the supply of pounds coming from the British. They're supplying pounds in order to get dollars. In this particular graph, we clearly see that we have an equilibrium exchange rate of $1.50. Notice this little line over here, this arrow over here that says depreciation as you go up. Let's take a moment to think about that. If the current exchange rate is $1.50 per pound and something happens to cause the equilibrium to be $2 per pound, what does that mean for the value of the dollar and the pound? It used to be the case that for every 1 pound you got $1.50, and then with this new change we would be getting 2 pieces of paper, 2 US dollars for every 1 pound. So the pound is getting more and more dollars for each one of the pounds, and therefore the pound is appreciating, which also means the dollar is depreciating. You're having to give more and more dollars in order to get 1 pound. That means the dollar is depreciating. So this is something you probably want to practice and get comfortable with as well. But what we want to focus on right now is our reasons that we want currency in the first place that we were just introducing. We've got them listed right here. We got buying goods or services, investing, or speculating. And we won't talk too much about speculation, but it is worth at least knowing depending on what other future classes you take. So what do these three things mean for actual factors in the real world that will change our supply and demand? So what we want to know is that, let's go ahead and do speculation. If speculation is happening, it's because there's an expectation by the speculators of the exchange rate changing, expected change in the exchange rate. Why do they have an expected change? Because they're traders. They have insights and information, and they're looking around, and they've decided based on their factors they expect the dollar to appreciate. If that's the case, that would affect their desire to hold dollars. And so in their entire portfolio, they'd want to shift so they have more dollars and fewer of everything else. And so you can see just from that description that speculation is going to be a factor in the shifting of supply and demand. But we're going to focus more on these other two factors. Let's look at what investing means. We're going to keep things simple. You can go into a lot more complexity with this if you want to go into finance and international finance and those sort of things. But to keep things simple, we just want to say that as interest rates change, that's going to affect people's willingness to hold foreign currency. Why is that? Because we're going to assume that people are reacting to, well, first of all, you're talking about people who are interested in investing abroad. So of those more savvy people, when interest rates change, they're looking at their vast holdings and they're wanting to have more exposure to the place that has the higher interest rates. And we're always saying relative interest rates because that's what matters. If one country's interest rate changes, what does that mean in relation to the other? So if one is relatively higher than the other, so we were at some sort of equilibrium, and now one country's interest rate has changed, so it's relatively higher than the other, then people are going to, from everywhere, are going to want to shift towards the country with the higher interest rates. So that's what's going to happen there. We're going to see that interest rates play a big role in shifting our curves here as people shift towards the interest rate. And what we're ultimately going to see is that that'll affect both sides of the market. Both the country with the higher interest rates will be pulling their money away from the foreign investing, and the people who are abroad who are seeing these interest rates go up, they're going to be shifting towards it. So that's going to actually have an impact on both curves. And then the third one we have here is goods or services. What are the things that affect our desire to buy goods or services? So one of them is going to be income, which we measure as GDP. As we have more income, our consumption is rising. That will mean our consumption of domestic and foreign goods is rising. And so again, that means we're going to need more foreign currency. And obviously, if it applies the other way, if the other country's GDP is rising, they're going to be buying more stuff. We're going to be exporting more to them. They need more of our currency. So GDP will be a measure of income and therefore show our increase or decrease, depending which direction it's going, in buying foreign goods. Price level will matter as well, and it's also going to be a relative price level. So there's some sort of equilibrium, then a change has occurred so that one country's price level is relatively higher than the other. And what does that do? Well, that's going to affect the apparent, what's the word I'm looking for? It's going to make you feel like one country's goods are more expensive than the others. This is something we'll go into more depth in a bit, but basically it's a long-run concept that when one country has inflation over the other, one country's price level has gotten relatively higher than the other, then the exchange rate needs to change to reflect that, to kind of take care of this price level difference. The process of the exchange rates changing to take care of this is what we will be seeing as we shift the curve. So price levels will have an impact. Basically, sum that one up as as a country that seems to be more expensive, people will buy less of their stuff. You're going to buy more in the country that seems cheap. You might even buy more in the country that seems cheap and then ship it to the country that seems expensive. But the overall impact will be on one of the curves where the buying will shift towards the country that seems relatively cheaper. And then the third thing for buying goods and services is one that we as econ people always need to have: tastes and preferences. That could always be a change in our desire to buy goods or services. So if we just have an increase in, we're doing dollars and pounds here. So if Downton Abbey has had the impact of making Americans just think everything British is awesome, then it's possible we would actually see an increase in our buying of British goods simply because our taste for British goods have changed. And obviously it can go both ways. We could have an increase in the taste for foreign goods or a decrease. And then obviously the British can have all these changes as well. They could have a preference that would increase for American goods or decrease. Okay, to sum up what we're saying then, that if we're looking at our market for the demand and supply of pounds for dollars, then here are the factors that can impact it. First of all, we'll just be looking at the demand for British pounds. So factors that change the purchasing by the Americans for goods and services, the things that will affect our purchasing of British goods and services would include our GDP, our relative price level. So that means that one or the other country can have more inflation than the other, and that change will shift our purchasing. and then the preference or taste and preferences for British goods. Any one of these can have an impact on the demand for British pounds. Factors that change our investing in the UK would be the other category. So this was goods and services. This is investing, and that could be the change in interest rates as we shift towards the country with the higher interest rates. And if we are doing any speculating, the expected change in the exchange rate. We'd want to hold the currency we think is going to go up higher and sell the other one. So we have the list we just went through here. These are things that shift the demand for pounds. And then here we have a similar list. You'll notice how similar. These are the factors that will shift the supply of pounds. So let's look at it real quick, and then we'll finish up with this in class the next time. Let's see, we have factors that change UK purchasing of goods and services, UK real GDP. Notice that the US real GDP changes the demand for pounds, but the UK real GDP changes the supply of pounds. But when it comes to the other things, like relative price level, that's actually affecting both of them. That's going to be a bit of a clue for you that when price level changes, it's affecting both sides of the market. But when it's GDP changing, only one thing is changing. If it's the US GDP, it's the demand for pounds. If it's the UK real GDP, it'll be the supply of pounds. Taste for British goods, obviously if that's changing in the US, it's only affecting the US curve, which is the demand for pounds. And if it's a UK taste changing, then it's the curve that they are impacting, which is the supply of pounds. Now, if we look at investing instead of goods and services, what are the two factors there? We see that relative interest rates are under both of them. So we're going to see an impact on both curves when relative interest rates change. And if there's some sort of change in the expectation, we're going to see a shift in both. So understanding these factors that will shift the demand and supply of these exchange rate curves will help us understand what will be the ultimate impact in the market. So I'll just finish up with one example. Here we're starting with our market, and we'll go ahead and say that we are at $1.50 per pound at the current exchange rate, and then the US GDP increases. And if you go back to our list, we see that only had an impact on the demand for pounds. And what it does then is, because our GDP is going up, because that means our consumption is rising, our consumption of domestic and foreign goods is rising, which means that we need more pounds. And so what that ends up actually doing is raising the rate. It goes from $1.50, and I'll just say it goes to $2. So the rate has gone up. $1.50 is smaller than 2, so that's an increase in the rate. But note what that actually does to the value of the currencies. You used to get $1.50 with 1 pound. Now you're getting $2. So it's actually the pound getting stronger, which kind of makes sense, because we're wanting more pounds, and they haven't had a change in how many dollars they want. So this is a result of our GDP going up. All right, that's it for the introduction. Where we are, if you want to look also at the PowerPoint, is we have completed the first chapter objective at this point. We're going to do objectives 2, 3, and 4 in class. And you need to now do the exercise that is posted on Blackboard. I believe there's about 6 questions. You'll have a few tries to do it, and get 100 on it, because there's no reason not to if you get a few tries at it. And we will see each other the following week so that we can finish up this chapter on Monday. Hope you enjoy your holiday. Well, at least you did get class off on Wednesday. At least we managed that. So I'll see you in class.